Trump's big, beautiful bill is rewriting the rules of retirement. It's quietly changing what you keep after taxes, how long your money will last, and what your kids will actually inherit. If you ignore these shifts, your secure retirement could end up vanishing under a system that no longer plays by the same rules. Hi, I'm Jason. I build retirement plans every week. Today, I'm going to share with you simply and clearly how these rule changes could impact you using a real world example and then also sharing 3 smart ways to respond. Because it's not politics, it's just policy. These are the rules on the field, and we'll use those to help you keep more and protect your legacy. Okay, so let's get to this real world example. We're going to go over Dan and Olivia. Dan and Olivia are married, so that means they are filing their taxes, married, filing jointly. Okay, so all the assumptions in this example are for that. So let's say their income is $100,000. Again, this is a simple example, but taxes work in a similar manner. So you have your income, but we typically don't pay taxes on that amount of income. We're allowed to actually deduct some things. So one of the rule changes that happened in terms of the big beautiful bill was the standard deduction. All right. So what is the standard deduction? The standard deduction is an amount of money you can take off the top that you don't have to pay taxes on. So one nice change about the big beautiful bill is the standard deduction was already increased, and it was increased a little bit more, and then those increases were made permanent. Now, I'm going to say permanent because they are permanent. They are the law of the land. But right now, that standard deduction was increased and made permanent. And in 2025, you could wipe out $31,500 off that income. Being able to wipe out $31,500 from our taxable income is great, but the standard deduction has been there in some form for many decades. Now, this next one, the senior bonus, that's really unique to the big beautiful bill. What is the senior bonus? Well, it's actually a bonus deduction. So if you're over the age of 65, and in this example, both Dan and Olivia are over the age of 65, they can each take a $6,000 deduction on top of the standard deduction, which is pretty unique and it really helps us when it comes to taxes. Dan and Olivia are on a roll so far. They've already been able to wipe out 31,500 from the standard deduction and 12,000 from the senior bonus deduction, all right? Now, Dan and Olivia also like to give to their church and a couple of other nonprofits or 501c3s. And with the big beautiful bill, there's an additional deduction, an additional charitable deduction. So, for a married couple, if you give up to $2,000 to a qualifying 501c3 nonprofit, you can deduct that from your taxable income as well. So Dan and Olivia, they hit that. So something else that's unique about number 3 and number 4 here, the senior deduction and the additional charitable deduction. Well, the nice thing about it is these did not exist before the big beautiful bill came out, and typically if you took a standard deduction, you weren't able to take additional many other additional deductions. So this is a very unique opportunity for retirees to really lower their taxable income. So let's see what this ended up doing for Dan and Olivia. Taking these various deductions, they're able to bring their taxable income down to $54,500. I mean, that's huge, right? They started with $100,000 and they got it down to $54,500. So, in the eyes of the IRS, that is what they're able to tax on. So, what were we able to do? Drastically reduce our taxable income. So, as you can imagine, Dan and Olivia are probably pretty happy they were able to reduce their taxable income by such a large amount. But Dan and Olivia also need to be worried about what happens when they walk out on life. And that's something we all need to be focused on. And that's why I want to invite you to click the link below, and we'd love to send you a free copy of our Quick Start Estate Planning Guide, which the first page has 3 simple steps. Number 1 helps you get all of your information in one place. Number 2, it tells you the list of companies that you will need to call. And number 3, it gives you the exact questions to ask, even scripts to use when you call those companies so that you can get your beneficiaries in order so that what you have goes to the people you love. So please click the link below and we'd love to send you that free guide. Okay, so back to Dan and Olivia. They've been able to reduce their taxable income, which means they will in turn reduce their tax bill. Okay, so they can save some money in terms of taxes. You got a little bit more money in your pocket. So Dan and Olivia have a choice what to do with this. Now, I can tell you, a lot of our clients say, "Hey, Jason, if I'm going to save some money on taxes, I don't want to enjoy it. I just want to have some fun." Now, I love this, right? Because retirement should be about enjoying. You've worked all of these years, and a lot of times retirees just need to be given the permission to go have fun. Now, going to have fun can mean traveling big trips to Europe. It can mean entertainment, going to a sporting event or maybe a concert. It can also just mean saying yes more. Because when we're in retirement, a lot of times maybe we want to go on that lunch or we want to go to that play, but we're a little bit worried about money. If we have some extra money in our pocket because we were able to save money in taxes, you may be able to just say yes more. Now, I would imagine some of you may say, Jason, I've already accounted for fun. If I save money in taxes, I want it to continue to help my retirement plan. So, what is something strategic I can do with this tax savings to help with my retirement plan and really to help with its longevity? And that's where we may want to consider a Roth conversion. Let's go over what is a Roth conversion and why would we want to consider doing it? Well, a Roth conversion is moving from a tax deferred bucket, think an IRA or a 401k, and moving to a tax free bucket. In this example, a Roth account. Now, if you move from an IRA to a Roth IRA, you have to pay taxes. Well, why would we want to do that? Well, from that point forward, as long as we adhere to the guidelines, once we move that money over into the Roth account, that money can grow and grow and grow, and then we can take it out tax free. So, why does this apply to Dan and Olivia's situation? Well, Dan and Olivia reduced their taxable income. So, they may have some income, let's say in the 12% or the 22% tax bracket. And we may say, let's do some Roth conversions. Let's move from their IRA to their Roth IRA because we can pay a lower rate in taxes to move from the tax deferred bucket to the tax free bucket. And that can help our plan long term. Dan and Olivia have been able to take advantage of a couple of the changes in the Big Beautiful Bill to reduce their taxable income and, in turn, their tax bill, which opened up some opportunities, additional fun, some strategic moves possibly in terms of their retirement plan. But Dan and Olivia in this example are also over the age of 70 and a half. And if you're over the age of 70 and a half, you have a special opportunity in the name of a qualified charitable distribution. So, what is a qualified charitable distribution? Well, if you're over 70 and a half and you have the desire to give, you already give money to a church or a charity, anything that is a qualified 501c3, this opens up an opportunity. Basically, instead of going ahead and giving out of your after tax money, you can go ahead and take money directly from your IRA and give it to that church or charity as long as they're a qualified 501c3. Now, why do we want to do that? Well, the thing is let's just say we take it out of this pocket, our after tax pocket. Well, then we gave after tax money to a nonprofit. But if we use the qualified charitable distribution strategy and take money from our IRA and give it directly to that 501c3, we kind of kill two birds with one stone. Number one, we get to help that nonprofit. Number two, we don't end up paying any taxes on that distribution and/or charitable contribution. I hope this example with Dan and Olivia helped to illustrate the changes of the one big beautiful bill that retirees can use to reduce their taxable income and in turn their tax bill. Now, this wasn't an exhaustive list of all of the changes of the bill, and it wasn't also an exhaustive list of all the strategies that you have. But I hope that it helps you realize there's a lot of opportunity out there if you just understand the rules of the game and you plan for it. So I want to invite you to watch this video here, where next I go over the question, should you take your Social Security early and invest it?